All right. Hello. All right. Hello, everyone, and welcome to the second day of the How to Buy Hotel and Multifamily Challenge. And today is day 2. My name is Davon Reese. For those who don't know who I am, this is your first time joining us. Welcome, welcome, welcome. And we have a special guest tonight. So I'm just going to give you an overview of what we're going to discuss. I'm going to give everyone an introduction, and then we are going to just highlight day 1, which I talked about briefly, introduce Tommy, who's our guest speaker, and then he's going to talk, then we're going to talk about, well, really he is going to talk about how to find hotels and how to analyze hotels, and we'll leave time for Q&A, okay? So just a recap, yesterday we talked about the different pathways to hotel ownership. So there are 4 different pathways. You can invest through crowdfunding, you can invest through a REIT, you can invest privately directly with an owner, you can become an active investor and do the syndication route, and you do the process yourself. Today, we're talking about how to find and analyze deals. Tomorrow, we're going to have another special guest. We're going to have a licensed financial advisor, Andre Williams, and he's going to talk about the preservation of wealth. And on day 4, we are going to talk about apartments. So I try to change it up. So for the people who've been rocking with me for a minute, I try to change it up so that way you're always constantly learning something new and you're always having a different experience. And so on Thursday, would love for you to stay to the end so you can learn more from Mike Ely, our business partners, how to find and analyze the deal. And then, of course, we'll always leave time for Q&A. And if you stay to the end, if you stay with me, stay with us until the final day 4, you'll get a special gift. All right, so I want to introduce you to Tommy Beyer. He's a good friend of mine. We've been friends in the industry probably for close to 15 years, if not more. I don't know. Stop counting after a while. And we met, we were a part of an organization. I think you were chair when I joined. So he's always been like a superstar in the industry. Yeah, I think he was chair of the American Hotel Lodging Association when I joined, and it was the Under 30 Gateway. So it was an organization for professionals under the age of 30. And Tommy was already a superstar at that time. He was the youngest. Once you were like a general manager by the time you were 30. He's been in the industry for over 20 years, managed over $1 billion in assets. Did you start the front desk too?
I started parking
No,
cars.
valet.
Yeah, I was
You did what?
valet.
That's
I
what
was
it
a
was,
valet.
valet.
Yeah.
Yeah, okay. Yep. See, almost remembered. So he actually started valet, and now he in a hotel, and now he is an asset manager, a consultant, and he's worked in operations. Like I mentioned before, he's been a general manager. He's worked in a management company. Now he's an asset manager for for my 3 hotels and Mike's 4 hotels. And just to name some awards, he's been mentioned top 30 under 30 Hotel Management Magazine. He won General Manager of the Year twice from 2 different organizations. He won the Stephen Porter Emerging Hospitality Leader of the Year twice, as well as the Financial Excellence Standing Bearer. So just to let you know, Tommy probably wouldn't have told y'all that. So that's why I was like, let me introduce you, because this to let you all know that you all are in great hands. And typically anybody that I bring to you all through a webinar or anything, I make sure that they're experts in the industry and that they know exactly what they're talking about. And as you can see, Tommy know more than me in hotels. I always tell them that all the time. And so I always do some trivia. It is Women's History Month. So how many, it's okay. I always say Tommy is invited to the cookout. But how many hotels are owned by Black women? The first person who gets this right in the chat, you'll get a prize. Okay, let's put in the chat. It's in the percentage-wise, percentage. Denise G got it right. Woo! So Denise G, what you're going to get, you are going to get a free copy of the How to Buy a Hotel workbook. What's included in the workbook, it also includes how to buy a multifamily, as well as Tommy's analyzer. Tommy's analyzer that he's going to walk us through today on how to analyze the deal. If you do not have this copy, I will put a link in the chat so you all can purchase it. It's $37, and it just is basically your homework. It walks through the ownership thesis. It gives you the list of hotels. List of websites. Just basically a workbook to help you buy a hotel, to walk you through it, and Tommy's analyzer and how to do how to buy apartments. So I put the link in the chat, and then please, Denise G, send me an email and let me know that you're the winner so I can get someone from the team to send you your prize. So congrats. And so, yes, the answer was less than 1%. So of course, my goal is probably less than like 0.5%. I was just being nice, but it's really low. It's like probably can count on maybe 2 hands, maybe one, how many how many hotels are owned by Black women. So I am going to pass the torch to Mr. Tommy, so that way he can share his screen and he can get us going. So Tommy, if you want to take it away.
You got it. I will do that. Well, guys, it's a pleasure to be with you this evening. I appreciate you spending some time with us. So I don't know more than Davon. She's very generous in that way about hotels. I'm always trying to keep up with her, but I've had the pleasure of working with her for a number of years now. So yeah, so I'm going to show you guys how to, we'll talk through a little bit about how to find a deal. So we need to kind of look at that. Let's go back to the investment criteria. So I'm going to pull that down here and kind of share that screen. Give me 1 second here. We'll flip this around. You guys should be able to see this right here, right? So we're going to talk through about creating your investment criteria first. I've talked through this with several students and clients in the past, and I think some people don't really think through this very well, right? So it's kind of like, you just say, I want to buy a hotel. Well, that's great. Well, what kind of hotel you want to buy? You want to buy a Days Inn on the side of, a highway? Do you want to buy a Ritz-Carlton on South Beach, right? Those are two different types of assets. So you kind of have to think through that. So that's option criteria 1 here, right? And that seems pretty simple, but people don't think about it. And then what ends up happening is if you don't have a well-defined investment criteria, you're kind of chasing all these shiny objects, right? So a broker says, hey, Davon or Adrian, whoever it is, you should buy this Hampton Inn. And you go, oh, wow, that looks good. And you go look at the Hampton Inn. And they say, no, you should go buy this, Marriott or something. And what you'll notice too is brokers will ask you, what's your investment criteria? And then I don't want you guys to be stumped by that. I want you guys to have really thought through that. So let's talk through some of the rest of these. So you got to define what kind of hotel. And that maybe your criteria will look something like this. I want to buy a hotel that's in the $5 to $10 million range in a mid-scale segment, chain scale. And if you don't know what that is, we'll talk through that. But that's more like, upper mid-scale will be like Hampton Inn, Fairfield Inn, Holiday Inn Express, those types of hotels you're probably familiar with. And I want to buy it in a 2-hour radius from my house. And it doesn't matter what age, right? Or maybe I only want to buy these kind of brands. I only want Hilton or Marriott, right? So that's part of your criteria. But some of the other options or questions are equally important. So like, when do you plan on investing, right? Is that, do you want to do that in the next, 3 months? Do you want to do it tomorrow, today? You want to buy a hotel tonight? Do you want to buy it in the next, 2 years? We kind of talked about where. So some people have this, sort of radius. They put their home in the center and they go, all right, I want to be able to drive to my hotel. So I only want to, I won't go, I don't want to fly. I want to make sure I can get there. Or some people, I only want to buy it in in my city, right? So there's a real narrow focus. And there's nothing right or wrong about either one of those answers. It's all, your preference. Maybe you want to be an owner operator, so you don't want to go hire a third party management company. That means you're going to be in there. This is your full-time job now, or maybe that's what you want to do. So where is important. Maybe you don't mind flying. Maybe you want to buy a hotel in the Caribbean because you like to go down there on vacation. That's fine too. So I think that the next question is also super important. Why are you investing, right? So is it to, diversify your portfolio? Maybe you've got all your money's tied up in stocks now and you kind of want to have some real estate. That's a good reason. Maybe you want some predictable cash flows to some extent. Maybe you want to take advantage of depreciation. Maybe you've got too much income, you kind of need to depreciate some of that on your taxes. That's helpful. Maybe you just want to tell your buddies at the country club or wherever you go that I own a hotel. That's fine too. Or all your friends on Facebook, hey, I own a hotel. That's no right or wrong reasons. And then how are you going to invest? So and that they'll talk about that a little bit tomorrow with Andre, but you could do like a self-directed IRA if your IRA allows you to do that. Maybe you've got some cash set aside. Maybe you're going to sell another investment property. Maybe you just won the lottery. That's great. And the other side of it is that's more kind of how are you going to fund it. The other point of that is how are you going to invest, and that's kind of what Davon talked about, those pathways to ownership. So that is, are you going to invest in a REIT, which is a kind of a fund? Are you going to invest in one deal? Are you going to syndicate it? So you're going to go out and raise money from friends and family and other people to help you buy the hotel, and then you're going to be the GP. So just take the time, think through those your criteria, right, and clearly define it. It doesn't mean that can't change, but you really want to define it. You don't want to just kind of be out there floating in the wind. And when you define it, it helps people, like brokers or investors. Maybe people want to invest alongside you, and they kind of say, well, Davon, tell me about your criteria. And you kind of talk for 30 minutes and you haven't really told it to them. It's kind of this elevator pitch, right? So you want to be able to boil this down in 30 seconds or a minute. And just like I said, I'm going to buy hotels that are no more than $10 million. They need to have 50 rooms or more, or 100 rooms or less, and they need to be something between, we're going to call it a Candlewood Suites to a Hampton Inn, or maybe you only want extended stay and they're going to be in the state of Georgia, whatever. That's your criteria, but just be able to clearly articulate that to somebody who asks. So does everybody get that? Any questions on investment criteria, what that might look like? Just throw it in the chat if you have any questions about that. But we'll keep moving on because I want to get to the analyzer. I want to show you guys what that's about. So here's a couple things to think about. So you say, all right, I want to buy a hotel, and you don't know where to start, right? So like anybody, you might Google it, right? I want purchase hotels, looking for a hotel to buy, however you're going to Google it. And there's a couple of sites already listed on here. So, and some of these you might be familiar with, particularly if you're familiar with other asset classes. So multifamily or industrial, self-storage, whatever, retail, whatever it is. And you can go to all these and they'll show you different properties for sale. So Crexy is one of them. LoopNet is one of them. Again, and then within those, you can go select hotels, or you can go select hospitality or whatever it is, and then it'll boil it down. There's other criteria. It might be deal size, it might be number of hotel rooms, like we talked about. It might be location. So you can kind of filter through. Just like I like to equate this to buying a house, right? You're on Zillow. Everybody knows Zillow or Realtor.com, whatever it is. And you go and define your criteria. You can save your searches. Just sign up for a free account, and then it'll email this stuff over to you. So before you know it, you don't have to go on the site. You can just check your email, and it'll say, boom, here's 3 or 4 hotels that have met your criteria. You should take a look at these. So those are the first two. 10X is a little different. I'm not sure if anybody's familiar with 10X or not, but it's made a lot of industry, headlines over the last few years. And what it is, it's an online auction platform. So you can go on there, you'll register, you have to, pay you have to put a deposit down to register. I think it's like 25,000 or something like that. And then you can go on and see hotels that are for sale on there that are being auctioned. I'm glad you heard of it, Charles. Yeah, it's a good site. So, the thing is, just like any auction site, there's kind of some, secrets to it, right? To some extent. Like everybody knows, just like most, the bids are going to come in towards the end, right? You might look and within these sites, there's about a 3-day window or something. So they'll say, all right, this hotel is being sold within these 3 days, and they'll start the bidding. And the price doesn't move much. Let's for argument's sake, say the hotel is for sale for $1 million. Uh, you know, day one maybe goes to 1 million. Day two maybe goes to 1.2, 1.3, and you're going, wow, this is great. I'm gonna get a good deal here. Day three rolls around, starts to move a little bit. An hour left, starts to move a lot more. 10 minutes left, and it's going crazy. So the other thing that to note is, and these people who work for these companies will tell you, there are internal bidders on these platforms. So it's kind of odd, and you don't really know who it is, but they've got like internal bidders that are sort of running the price up. And there may or may not be reserves. And usually the list price, they're looking for about 3 to 4 times that price to end. So if they price it, as an example, they price it for $1 million, the end price that they're trying to get is somewhere usually between 3 and 4 million. So, just keep that in mind. When you kind of see it, just you go ahead and multiply that out to understand, where you think the deal is going to fall. But also on 10X, you have to be able to buy it cash right away at closing. So you can get some good deals on there, but you've got to be pretty liquid, and you do have to be careful. I saw a lot of my friends were getting some pretty good deals on there right around COVID, but these were people that had 5, 10, $20 million liquid that could just click a couple buttons and buy the hotels. So it's not for everybody, but it is an option. Hotel brokers, it's a great source, right? So there's all kinds of different brokerage firms out there. There's CBRE, there's Hodges Ward Elliott, there's Hunter, there's Marcus and Millichap, all kinds. And the other thing to note about them is they have specific people in specific parts of the country that will focus in on their areas. So if you live in Atlanta, there's a bunch of brokerage firms based there, like Hodges, Ward Elliott, and Hunter, all based there. But like CBRE, that's a huge national company, but they've got a couple teams dedicated to hotels in the Atlanta market, right? So you'd want to get on their mailing list, right? So eventually you might sign a confidentiality agreement, you get on their mailing list, and then you'll start to get fed deals as well. And especially as you have conversations with these brokers, you tell them about your investment criteria, and then they say, oh, here you go, Devon. These are some hotels you'd be interested in. Boom, and they'll email it to you, or they'll call you. So, be careful. Just like anything, if you kind of put your name and information out there, before you know it, you're going to have, more deals coming your way than you know what to do with. But that can be a good thing if you're really interested in it. And the last point on here is networking at industry conferences. So there's about half a dozen bigger industry conferences when it comes to hotel investments every year. You have in January, you have one that's called ALIS. It's the America's Lodging Investment Summit. It's in LA towards the end of January. And those are more West Coast focused people. In March, you have the Hunter Hotel Conference, and that is in Atlanta, more Southeast based. So that's coming up in mid-March, a couple weeks here. In June, you have NYU, which is New York University. They put on a hotel investment conference in New York City. So that's kind of more institutional groups and Northeast focused. And then you also have the lodging conference, which is in Phoenix in September or in October this year. And there's people from all across the country out in Phoenix for that one. And there's a handful of smaller ones, but those are some of the bigger ones. Most of them you want to pay to register to go in and attend the sessions and learn. Some people don't do that. They just kind of want to network with brokers and things like that. So some conferences it's easier to do that at, but a lot of them it's pretty difficult now because they're looking for your badges and all that type of thing. So that's how you find hotels. Let's hit some key KPIs real quick for you guys here. And these are the big ones to know of when you're buying a hotel. And they're super basic, really easy calculations. But if you're new to the industry, you might look at this and this might look like, a different language to you. So occupancy is the first one, right? So KPI is key performance indicator, just to make sure everybody's got, up to speed on all your acronyms tonight. Occupancy is calculated by the number of rooms you sold for any period divided by the number of hotel rooms available. So let's just use real simple math. I know it's 7:30 at night. We had a full day at work, but I'm going to take it easy on you guys. We have a 100-room hotel and we sold 50 rooms. What's our occupancy? Somebody put it in the chat. There you go, Michelle. Michelle is on it. She's ready. All right, 50%, right? 50 rooms we sold for the night or for the month or for the year, and we had 100 to sell, right? So simple. Hope 50% is not good. For the most part, it's not a good number, right? You want to sell more. Here's another question. What's a good occupancy percentage? This came up recently when I was talking to some different clients. What's good in the hotel world? Throw it in the chat. In multifamily, you hear people say like you need to be at 95% and above, right? So I've seen some 80, 85, 60, 70. Yeah, appreciate you guys throwing that in there. The question is, it's a trick question to some extent. There's not a perfect answer to that, right? The truth is it's market driven, it's property driven. Osmond said depends on operating expenses. That's true. So what you hear people say is if your occupancy is above 85%, then you're not charging enough for the rooms. And that's, and that's really more talking about for the day as an example. In some cases, you can't charge more, right? There could be constraints on the market. It could just be like a government heavy market or something like that. So, 80, I'd say a good occupancy is somewhere in that kind of 70 to 85%. That's pretty decent for a hotel. If you get beyond that, you kind of have to look at your rate strategy. But that may be a good operating model for the property. But it all does vary. But hotels are not like multifamily in that if you're not running 95%, you're not doing well. That's not true with hotels. But it is a perishable product. And by perishable, I mean the rooms you sold that you didn't sell tonight, you cannot go sell tomorrow, right? It's just like an airline. They didn't sell seats on that plane, the plane flew, they can't go sell those seats that they didn't sell on any other flight. It's perishable, it's gone, right? So you have to think about that with occupancy, with your rooms. The next one, ADR. So that is the revenue for any period. So for the revenue for the day, let's say, divided by the rooms you sold. It's your average daily rate, right? So again, real easy math here. You have $10,000 in revenue for the day and you sold 100 rooms. What was your ADR? It's revenue divided by the number of rooms you sold, right? Easy, 100, right? So $100 ADR. ADR, there's not a good answer to what's a good ADR, what's a bad ADR. RevPAR, that is your revenue per available room. So that's why PAR is capitalized, it's per available room. So the calculation there is the revenue for the period divided by the available rooms. So now, let's just use the same math. We sold $10,000 and we have 100 available rooms. The RevPAR there was $100 RevPAR, right? Because we have 100 available rooms. And the reason why, so the industry has changed a lot. And we'll get moving a little bit faster here in a second, but the industry changed. At one point, the industry was focused on heads and beds. You may have heard that phrase before. And kind of the old school guys in the business still say that, which is wrong. And what they were saying is, you need to get as many people to stay in your hotel as you can. We need the occupancy as high as we can. And then the industry said, yeah, you know what? We need to get average rate. We need to charge people more. And that's the fallacy, right? Because if you sold one room for $1,000, but you didn't sell all the rest of the 100 rooms you had in the hotel, you made $1,000. You had a really good ADR, but you made $1,000, right? Instead, if you sold all the rooms for $100, you made $10,000. So that's where the industry kind of shifted and said, you know what, we really need to pay attention to the available rooms we have and how much revenue we're bringing in for each of those. So, from a KPI perspective, the most important number on here is RevPAR, right? So when you're looking at hotels, you really want to think through what's the RevPAR. And I'll give you some real high level metrics. Some people I know at a publicly traded REIT have told me in the past that they used to want to be at, and this was probably 10 years ago, they wanted to be $100 RevPAR markets. Their hotels need to be $100 RevPAR or more. Now that's pushed up for those guys to about 120 or 130. And the reason they're focused on that is the higher the RevPAR, the better chance you have of making more net operating income, right? So just think about that. If you're buying a hotel that has a real low RevPAR, it's going to be a lot harder for you to make profit because the revenue you're bringing in for each of those rooms is not a lot. So those are some of your main KPIs. All right, so let's break it down. Let's get into how to analyze the deal. This is why we're all here. This is why we signed up at 7 o'clock at night, because we don't want to binge watch TV. We're trying to make some money tonight. So let's learn how to analyze the deal. So what Devon said, and I think can go back to whoever won earlier. Congratulations. I think it was Deborah or somebody. You're going to get access to this deal screener. And then Devon put a link in there. If you wanted to buy the workbook plus the deal screener, you can do that. But what this is something I put together, I don't know, maybe last year or something. But I got kind of tired of doing these really full-blown, detailed pro formas that could take hours, right? And I said, I need to find a way to shortcut this. I need to find a way to boil this down and to set, within 30 minutes or less, plug in these numbers and know if this is a good or bad deal. I need to understand that, and I need to be able to show somebody in case they say, hey, did you analyze the deal? What does it look like? So I put this together and I think it's really valuable. So I'll show you guys how to do it. So again, anything that's a blue cell is an input cell. It's pretty basic. It's just Excel. We're not trying to, make you guys make pivot tables or anything crazy tonight. So first thing you're going to do, you're going to fill out this deal data portion. The other thing that's helpful here is there's an instructions tab. So in case, you don't want to go back or in case you fall asleep here, you can go to instructions. So the deal data tab is easy. You put in the name of the hotel, the number of keys. Keys are same as rooms, right? So keys are same as rooms. So 120 rooms in this example, the year it was built, 2008, okay? Next we're going to put in the acquisition price. So this can be a couple things. This can be whatever the guidance is from the broker. So you say to the broker, okay, what's the deal selling for? And they say, all right, it's 12.5 million. You can also put in what you're willing to pay, right? I usually kind of start off closer to guidance because I want to see how the deal pencils without me sort of massaging it down to a number that I'm more comfortable with, but that's kind of where I start. And then you'll notice everything, this is already calculating your per key cost. And in the hotel industry, not too different from multifamily, a lot of people pay really close attention to what does it cost per key or per room. Okay, so we're buying for 12 million, 12.5, that's 104,000 per room. So you have 120 rooms. Next is working capital. So if you're going to buy a hotel, even if it's cash flowing, you still need to inject some capital. So usually you know, if you get a management company, or if you're going to run it yourself, you're going to need some money for payroll, or you might need some money for things like utility deposits and some of that stuff. So maybe we need some working capital. We're going to put in 50,000 in here. Sorry, 50,000. And then key money. So the question is, what's key money? Anybody heard of key money before? Key money can come from one of two ways, primarily one way. It usually either comes from a brand or management company, for the most part from a brand. And it's money that's given to you as an incentive to sign with that brand. So usually key money is given on for the most part, it's given on new build, but it can be given if you're converting, or if a franchise, yeah, you've got it, Osmond, or if the franchise license is expiring and the franchise says, hey, we really want you to keep this a Holiday Inn. We know you could make it 3 or 4 other brands. We'll give you some key money. So maybe in this case, let's just say we're going to get $500,000 from the brand, and we're putting it as a negative because that's going to reduce our total acquisition price, right? So we're getting some key money. Next, PIP. That is your property improvement plan. So a PIP, you can think of it as a renovation, right? But on a branded hotel, the brand walks it, and then they come in, they inspect the hotel, and they issue what's called a PIP. And then what they're doing with that, and it'll list all kinds of things. It'll go area by area. So they'll start in the exterior, and they'll say, maybe you need new signage, or you need, because your signage isn't the latest logo, right? Or maybe you need to put in new landscaping or whatever. And it'll go through every area. It'll go through your guest rooms. It'll say maybe you need new carpet, all these different things. And that's all that collectively is your PIP. And they'll give you a time frame on when you need to get these things done. Now, they're not going to give you any prices on this stuff, so you've got to go figure that out, which we could talk about at a later date. But there's going to be a cost associated with this. Unless it's a brand new hotel, then your PIP is going to be pretty low, or maybe they just renovated. But in this case, for this example, we're saying the PIP is $2 million, which is $16,000 per room. And the last part is your closing costs, right? So we've got a little formula built in here, which has got about 2%. You know, you can plug a number in there. It's okay. There's going to be things you're going to have to pay. Again, if you're new to this, think about it as anything else you any other real estate transaction you've done. Maybe you bought a house, probably you bought a house, you had a home inspection, right? You had to pay for like a survey and all those kinds of things. You're going to have to do the same for a hotel. It's just on a different level, right? So you're going to have to pay for somebody to come do a property condition report, a PCR, or a property condition assessment, a PCA. And they're gonna go through, they're gonna walk everything just like a home inspection. They're gonna say the roof is old, or you need this, or you need that. But all these things cost money, or maybe you've got legal fees. You're gonna have to pay a lawyer to help you close the deal. So you've got to factor all that in. All right, so our total price is 14.3 million, 119,000 per room. Everybody following? You good? Give me a thumbs up. Let me know you're still awake. You didn't go get a soda from the fridge. We're following. All right, cool. Thank you guys. I appreciate it. All right, so we've got our deal data. We're moving over. We're going to historical data. So what this is going to the broker, and you're going to get these information from the broker. And we've got 3 years here. So we've got 3 years. This is year 1. You can change the year to whatever year you have, year 2 here, and then year 3. Okay. And we're putting in what the hotel has done in the past. So in this case, 2021, it was 75% occupancy. It went to 77, then it went to 80. We put in the ADR. And guys, you know these KPIs. We just went over them. It's simple, right? Average daily rate was 120, it went up to 122, and then it went up to 125. We're calculating the RevPAR for you. So the black numbers, we've already done that for you. One was a $90 RevPAR in 93, and then went all the way up to 100 in year 3. The room revenue is calculating 3.94143. F&B, you'd have to plug that in. In this case, the hotel doesn't have any, so there's no food and beverage. But if it did, you can put it in. Miscellaneous revenue, everybody know what that is? Anybody unclear on what miscellaneous revenue is? Any ideas? So miscellaneous revenue in a hotel, kind of think through when you're walking around a hotel. You have a pantry, right? You go in, you have a little gift shop, boom, that's miscellaneous revenue. Maybe somebody was very dirty when they stayed, they had a party or whatever. Yeah, Osmond's got it. Or maybe they have if they have a party and they trash the room, you're gonna charge them a cleaning fee. Maybe they brought their nice little dog with them and they get a pet fee, right? Maybe there's a late cancellation or no show or all those types of fees. All those are miscellaneous. Maybe they, use the internet, you're charging for internet, that's miscellaneous revenue. So then last you have your total revenue for each year calculating. And then again, this is a high level screener. It's a screener, it's like an analyzer. This is not to go super deep, right? We're not talking about a full-blown pro forma. We're just trying to shortcut it and figure out if this deal works or not. So the next thing is GOP. Anybody know what that stands for? GOP? It's your gross operating profit. So that is your total revenue subtracting out all your operating expenses. So Tamika's got it. So operating expenses, as an example, would be your payrolls, it's going to be your utilities, it's going to be, maintenance, anything it takes to clean the room, all these different things are your operating expenses. And that's going to give you a gross profit right here. It's not the money you're taking to the bank, but it is a good indicator of how the hotel is performing. And it's really the metric that you're going to look at and hold the property accountable to, largely, because the property is not responsible. They can't really control your property taxes. They have very little to do with insurance or anything kind of that's below that gross profit line. So in this case, 1.15 million, that's 28% profit. And then it went up to 30% and 30.8 over the last 3 years. And again, we're identifying trends as we're going here. So we're going to get to NOI. You got your net operating income here. That is what NOI means. That's your gross operating profit. And we're subtracting out things like taxes, property taxes, insurance. Maybe there's a land lease or any of those kind of things. That's how you get to your net operating income. And lastly, we're calculating your cap rate. And that might be new for you guys. But cap rate, and if you look at the formula here, it's just dividing the NOI, the net operating income, by your total purchase price. So year one here is a 6.6 cap, year two is a 7 cap, year three is an 8 cap or 8%. And if this happened to be a 10 cap, so let's just say 10%, what it means is in 10 years, you will have paid back the acquisition price based on the net operating income, right? That's how it's 10%. So if you multiply that out times 10, we're going to get back to our 14.3 million. So you get it? Does that kind of make sense on what a cap rate stands for? Capitalization rate. And it's super common in not only in the hotel industry, but in all commercial real estate. So the lower the cap rate, the longer it's going to take you to pay back the acquisition price. The higher the cap rate, the shorter time frame it's going to take to pay back what you paid for it. So, all right, we've got our deal data, we've got our historical data, and now we're going to move on to pro forma assumptions. So this is where you kind of have to polish up your crystal ball and get a little good at predicting the future. So the first one is, probably the line that's going to change, the most, or, you're going to have to tweak a little bit. This is an annual inflation. And what we're using here is to say, all right, look, I'm going to go predict what I think the hotels can do in year one. So this is a full year after you've owned it. I'm saying it's going to do 80% at $130 average rate. So the RevPAR is a 104. Keep in mind, I'm going back and I'm looking at my trends. It did 80 at 125. So that's not too aggressive, doesn't feel like, but you have to understand what's going on in the market. There's all kinds of different things you have to figure out. So that's going to calculate the room revenue. I'll get back to this inflation in a second. It'll calculate your revenue. Then you're going to put in the miscellaneous revenue, and then you're going to put in your GOP, your gross operating profit, and your net operating income. So you'll notice here that this is 40%. The gross operating profit is 40%. And it was 30% here. So that's where we've gotten pretty aggressive. And the net operating income was 26%. And we've got that going to 32%. So that's a pretty aggressive adjustment. And that maybe the operator that was in there wasn't doing a good job. Maybe you've looked at it and said, I'm going to bring in somebody else, another management company, or I just know that this type of hotel should have a better net operating income, right? And this stuff is, it's harder to figure out as you go, but the more deals you analyze, the easier this becomes, I promise. It's just, it's like riding a bike, maybe you fell down, maybe you're unfamiliar with it, but just look at it again, right? And you'll get more familiar with it. So that's where we've gotten kind of aggressive on this deal. So this would now be in year one, a 10.3 cap deal. And then we've got to go say, okay, so we know what we're going to do in year one, but what are we going to do in the future? So we got pretty aggressive here, and in the future, we're just saying we're going to go up 3%, right? That's our inflation. So every year we're going to get pretty much a 3% increase in net operating income, not by percentage margin, but just by so it'd be multiplying this 1.48 times 1.03 essentially to get a 3% increase. So I hope that's clear. We're not going to take this to 35% and 38% and 41%. We're just saying this net operating income is going up by 3% a year. So those are our pro forma assumptions. When you were doing a full-blown analysis, you're going to go year by year by year. You're going to project out revenue by each year. You're going to project out expenses by each year. And you're not going to just use this kind of a plugged inflation number. But we're trying to shortcut it. Remember, we don't have time. We need to get through this. So we're going to try and shortcut this is what the purpose of this analyzer is for. Jackie, I see your question. We'll get to that in a minute if we have a chance, or Davon will jump on it. So the next one is your debt assumptions. So we've got to go now assume, what kind of debt can we get on the property? So in this case, we're putting in the loan amount. It's a 60% LTV, which is loan to value, which is, that's pretty conservative. Depending on the deal, maybe you can get 65%, 70%. It just depends, because of where the debt markets have been lately, it's harder to get those higher loans. So it's hard to get like a 80% LTV as an example. So in this case, we're using 60%. So that's the loan. Then the equity is going to be the difference. So it's 40% equity. We're using an 8.25% interest rate. Again, you talk to a debt broker, you can talk to different people in the industry. They can help you understand, maybe where some of these numbers should be. If the deal is, if the deal is a little thin, or if it's more based on the pro forma, maybe this interest rate's a little higher. But if it's had a predictable cash flow and it's in a really good market, maybe you get a lower interest rate by a little bit. That's, it's not uncommon to see right now, to see deals anywhere between kind of high 6s on interest to 9, depending on the deal, maybe 9.5. I know that's a pretty big range, but that's kind of what I'm seeing out there right now. So amortization, we've got 30 years, and we've got a total payment of $781,000. And the last thing we have to figure out here is, when are we going to sell? Okay. And what cap rate are we going to sell at? So we already told you what a cap rate was. We're saying in year 5, we're going to hold this thing for 5 years. We're going to sell at an 8.75 cap. That means the sale price is going to be $19 million. Remember, we paid $14.3. The selling expenses, you're going to pay a broker some kind of fee or whatever. So we just use 2.5%. So the net sales price is $18.5 million. Per room, we're selling it for $158,000. Remember, we paid $119,000. So now it's pretty good. And lastly, it calculates your internal rate of return, or your IRR, which we've come up with a 24.5. So the question is this a good deal or a bad deal? How does everybody feel about this? If you were to get a 24.5% return on a 5-year hold, you like it? It's good, bad? Are we buying it? Are we selling it? Are we not doing it? Yeah. Yeah, you guys got it. It's good, right? And what yeah, it's great. Exactly. What you're seeing now is a lot of people are kind of in the high teens, call it 18, 19% return, maybe to low 20s. If you can get to 20, 21, 22, you're probably doing pretty well on your IRR. But keep in mind this, this wasn't so conservative because we pushed really hard here on our NOI. We went all the way up from 26% to 32% in the first year. I've seen it done before. It doesn't mean it's impossible, but I'm just telling you guys, we kind of pushed it a little hard here. So that is how we, sort of, shortcut a deal. And this is the analyzer that we've got, which again, you guys could purchase if you're interested in, plus the book. And so there was a question earlier I want to get to real quick. So Jackie asked, are land leases common? And what you'll notice, I'll get to that question, but what you'll see is on deals, they'll say it's either fee simple or leasehold. And I don't want you guys to be confused by that, but fee simple means you own the dirt, the fee meaning the land. Leasehold means you're paying a land lease to somebody. In the hotel industry, are they common? They're more common depending on the market you're in. So as an example, if you're in a major downtown metropolitan market, Northeast, sure, that's pretty common. Like in New York City, land leases are super common because people aren't going to sell you the fee. They're not going to sell that dirt. They're less there, but they're not, but ultimately they're not super common. I'd say that, and I don't know the percentages, but if I'm guessing in terms of the number of deals I look at, lease deals are probably somewhere in the 10%, 15%, yeah, near the airport. Really good point. Osman, yeah, it's airport deals. Usually the land is owned by the the airport and the municipality there. So yeah, so leasehold deals are not super common, but there are areas where they can be, pretty common. So what other questions do you guys have? I know I kind of blew through that, but I hope it was helpful. It's, what you'll notice too on here is if you kind of tab through, you can see some acquisition data. If you guys are sort of data nerds, you can go in and see how things are being calculated. You can, you can look at all that. And then again, there's instructions for you as well. So what other questions? I know you guys have some questions. Any good strategies
Classes,
for,
it says,
go ahead.
do you see it, Tommy? Jackie asked, what are some red flags?
Yeah, I mean, there's all kinds of red flags out there. I mean, some red flags are they're not willing to, the seller's not willing to share the data with you, right? That's a red flag. It's a red flag because, they haven't been tracking the numbers, or they're not willing to share them, or they've got two sets of numbers or something like that. So that's a red flag. Another red flag could be that their margins are elevated. So like maybe this net operating income is like 50%. And then when you go do your analysis, you say, I haven't really seen a deal that's got 50% NOI, or this hotel really shouldn't run that. That's a red flag. And it's not impossible, but what you can find too, especially in some of these economy deals or lower price deals, is that there's a lot of owner operators, meaning, my wife is running the front desk, or my brothers and his family are cleaning the rooms and I'm paying them on the side, and none of that's getting run through on the expenses, right? So that's a red flag. You could get there's some red flags may be that a broker is telling you that the PIP is really cheap, but by the time you start to look at the numbers, you realize what they're telling you wasn't true, right? Or the seller's telling you we did all these things and actually it wasn't true. That's a red flag. So let's see, what are some good strategies for projecting food and beverage numbers? Yeah, I mean, food and beverage can be a little bit trickier to predict. I mean, by and large, it depends on the deals you're looking at, but most of the deals, food and beverage is not going to be like a super significant contributor. It depends. I mean, like I said, especially on a select service, it's not going to be like a huge component to what the hotel's doing. Now, if you're focused on a hotel that has a lot of food and beverage revenue, you're going to look at the historical trends. It's good to benchmark off of other hotels, and when you do that, you have to be really careful to find like brands and like size hotels, like meeting space, like markets, all those kind of things to benchmark off of. You can speak to other operators, management companies, other owners. They'll help you with that a little bit. So I'd just say, the more research you do, the easier it becomes. And in most people don't know this, but in a lot of hotels that offer food and beverage, especially select service, you're losing money off of food and beverage. So Danny says, how do we find great deals, or where can we find the best deals? That's a tough question, but we kind of went over before, how do you find deals? But I'd say, the more you're out there in the industry, the more you're talking to people, the more they're willing to share you kind of these off-market deals. But there's not like a secret website I could sell you access to where you can go find it all. It's, that's hard. It's like saying, how do I find the best apartment deals? Well, that's, the better reputation you have, the more people know you're sort of serious and you're out there in the industry and you've got, a good balance sheet, you got a lot of money behind you. That's helpful. So sort of, these are good questions, guys. I like it. So what's average cash on cash or IRR? Yeah, we kind of talked about the IRR. I mean, usually it's people are looking for high teens, so call it somewhere between 18 to low 20s is really what you're looking for. Cash on cash is going to vary. Maybe that's high single digits, low, like maybe somewhere between like 9 and 10 or 11 is what you're looking for, maybe on cash. Yeah, so what if there's not good historical data for good reasons? That becomes harder. With that, you're going to have to really spend some time again going kind of building your own detailed pro forma, which is something we'll get into at a later date on a different type of call. But on that, you're really going to have to spend some time deciding what do I going to pay people, or what are normal costs, and you have to dig a lot deeper to project out your future revenues and expenses. But there can be good reasons, and that might mean you're just going to get a better deal because you say to them, "Hey, I don't have good data here. It's going to be harder for you to get a loan, and as a result, I can't pay you what you think the hotel's worth." Right? So let's see, what else do we have? For average daily rate, should we assume it should go up or down for the next 5 years? Yeah, so that is super market by market, street corner by street corner, almost kind of micro market specific. There are all kinds of different industry publications out there that will project that for you. That will help to project it, but they're never going to be able to say, your hotel is going to go up X amount over the next 3 years. All you can do is look at what are the historical trends, what are the recent trends, and then what do you know about the market? Is there something big changing? Maybe there's certain markets where there's like in upstate New York, they're putting in these big chip factories and it's going to bring in a lot of demand. So you should assume average rate's going to increase there. So let's see, what else do we have here? So for syndication, what's a typical split? Varies. I mean, it's going to depend on what the GP is putting into the deal. If the GP is not bringing in a lot, maybe there's I kind of see deals set up where there's like an 8% preferred return to the LP, the limited partner. Then the GP, maybe it's like an 80-20 split after that or something, or or 70-30. It kind of varies. What I always tell people is like, on your first few times you're syndicating, you're going to have to do deals that are going to be more in favor of the investor. And as you build up that track record, it becomes a little easier for you to kind of stick to your guns on your promotes and that kind of thing. All right, so Michelle, it's a good question. Should we do this type of in-depth analysis for each deal, even if we are more on the passive investor side? Yeah, so you don't have to. It sort of depends on how comfortable you want to get with the deal. I mean, I'd say like, look, if I was going to invest 50,000, 100,000, whatever the number is, I think it's worth your time to go through something like this now, and just to be comfortable with the numbers you're looking at, or at least to ask somebody for whatever they've put together and then review it. I don't think that if I was a passive investor, I'd necessarily be, out there looking for deals on my own and running through this analysis for every single one. But if I'm pretty serious about it, yeah, I would take the time to do this. How do you underwrite a recession in the pro forma? Yeah, so yeah, it depends. What I've done on that is, obviously we've gone through COVID, which was crazy for the industry. But I usually have on like a more detailed analysis, I'll have kind of an upside scenario. I'll have my base scenario on revenues. I'll have an upside scenario, and then I'll have a downside scenario. And it sounds like a lot of work, but once you do your base, it's not that hard. So then you can kind of toggle around and say, all right, look, if I think in my downside scenario, meaning there's a recession coming, I'm going to drop occupancy in year 2 or drop rate or whatever, and then I'll know what my returns are. So I think you're better off kind of coming up with a couple different scenarios for that pro forma. So there's a bunch of these. This is good, guys. So if you're looking at somewhat distressed or older properties, where on the analyzer shows how much should be allocated to improvements and how are those reached? Yeah, so that's going to be really in this PIP part. So if it's distressed and you're going to have to put that money here in the PIP. And I probably glossed over that, but not only does the brand give you what they are requiring, once you get that property condition report or that PCA or PCR, kind of like your home inspection, when you get that report back, then you can look at it and say, okay, well, they're also saying my boilers are very old, or my roof needs to be replaced, or my elevator needs a modernization. And all that's going to have to layer on top of the PIP. So you can just plug that number into here, so think of it as a renovation number. But you can also use that to go back to the seller and say, hey, look, you said the property was in great shape, but this report now says I need to do 2 boilers, 3 elevators, and a roof, right? So give me a discount. And Davon, stop me if you want, because I'll just keep rolling through, but these are really good questions. So Danny says, one deal I'm looking at only has an NOI of 100,000 and they're asking 12 million. It's a nice location. How can one justify what can be wrong and why they're asking so much? It's a Holiday Inn in South Carolina. So, the real question is like, why is the NOI $100,000? What do you think it could be? Maybe it's a new hotel. Nice location is helpful. The broker and the seller should be able to clearly tell you why the NOI is so low. I would say though, be careful, because sometimes people are putting interest above that line and they're wrong. They shouldn't do that, but just double check. Sometimes you'll see like $1 million in interest or whatever, 700,000 in interest. So if it is, just go add that back to your NOI. But that'd probably be my guess there. And the other thing is, a bank isn't going to give you a loan. They're not going to give you like an $8 million loan and $100,000 NOI. So that's tough. So I've seen syndicators charge 6% of revenue as a management fee instead of a GP. But yeah, I mean, it sort of depends on, you kind of would want to feel out your investors a little bit. I mean, maybe they're doing some management there too. you know, I've seen people do like an asset management fee of like 1% or 2%, and then maybe the split isn't as much or something. You know, there's no right or wrong answer to that. You know, it all kind of is math in the end of the day. Is like how much is fair for you to get paid as a GP, and what are you really doing for that work. So, all right. So, what's the fastest way to exit from a bad deal? Maybe you just light it on fire with, you know, with some matches, and that's the easiest way. No, I don't know. You know, that's a tough question. It depends on how you're involved in that deal. It depends on all kinds of different factors. You know, you could partner with somebody on it. You could hold some paper, maybe, you know, I've seen that where, you know, some people are kind of selling into an upreit. So what that is you're exchanging your equity for shares into a REIT or a fund, and in that case, then the REIT takes on the liability for the property from a operating perspective, and then you can kind of share in the upside. If that REIT is interested in that might be one way to do it. And then, yeah, I'll throw my LinkedIn on here too for you guys, so you can find me there. But listen, I appreciate your time. It was good to connect with everybody tonight for sure. Hopefully that was helpful, and thanks for being so engaging. It's really helpful. So, Devon, it's your show now. Take it away.
Here, I was trying to get your LinkedIn.
I got it. I'm sending it out there.
Okay, all right. Let's see. All right. Well, thank you all so much. So Tommy was great. Wasn't he great? Wasn't he awesome? Did you learn a lot? Ah, I love it. I love it. So I'm glad that you all learned. So tomorrow is the third day of the challenge, and we're going to have Andre Williams, who's a licensed financial advisor. He's going to talk, and then we're going to have no. Hold on for just 1 second. I have my little one. Can you hear him? Can you hear Jameer?
A little bit.
Oh, okay. He's always jumping me. So anyway, so because it's his bedtime actually. But so tomorrow will be Andre Williams, licensed finance, and then your homework for tonight is we want you to go ahead and start looking for deals. That's your homework for tonight. We want you to go ahead and start looking for deals. So start using the analyzer. Just start going through it. So that is your homework. When you're finished, you're going to put your badge in the Facebook group. But yes, let Tommy know in the chat how much you appreciate him. The replay will be in the dashboard, so you'll get a link within 24 hours where you can watch the replay. We appreciate you all so much for tuning in, and we will see you all tomorrow.
Take care, guys. Have a good night.
Have
Thanks
a
for
good
your
night.
time.
Thank you, Tommy.
Thank you. You too.